Picture this carefully, because what I am about to describe has already happened to real retired Canadians, and it could happen to you without any warning whatsoever. A retired couple living quietly in Ontario receives a lump sum inheritance from a family member overseas totaling $60,000 in cash. They are not criminals. They have never been in trouble with the law a single day in their entire lives. They have no connection to anything illegal. They simply do not know what to do with that much physical cash sitting in their home, so they do what feels like the sensible and cautious thing, and start depositing it in smaller portions, a few $1,000s here, a few $1,000s there, spread out over several weeks because that feels safer and more manageable than walking into a bank with $60,000 all at once. 6 months later, they receive a phone call from their bank, and everything changes in an instant. Their accounts have been flagged, not audited, not reviewed, flagged and formally reported to the federal government of Canada. And because of the specific pattern of those deposits, multiple amounts all carefully and consistently staying below $10,000, they are now under active investigation for a serious criminal offense that they had never even heard of before that phone call. Here is the critical thing that most Canadian seniors do not know, and that nobody ever explains to you in plain language. It is not just large deposits that trigger government reporting and surveillance. It is the pattern of repeatedly staying under the $10,000 mark, even without consciously realizing that is what you are doing, that can transform your perfectly legitimate money into the basis for a full federal investigation. Today, I want to walk you through exactly how this rule works in practice, what the hidden trap is that catches ordinary retired Canadians completely off guard, and what a significant new law currently being debated in Ottawa right now could mean for every single retired Canadian who handles cash in any amount. FINTRAC stands for the Financial Transactions and Reports Analysis Centre of Canada, and it is a federal agency that was created in the year 2000 under a law called the Proceeds of Crime Money Laundering and Terrorist Financing Act. The original goal when this agency was established was to track money being laundered through the Canadian financial system, including drug money, organized crime proceeds, and terrorist financing, which was and remains a legitimate and important goal. Here is how the system works in everyday practice. Every single financial institution operating in Canada, including every bank, every credit union, every money services business, and every casino, is required by law to file what is called a large cash transaction report anytime you deposit or transfer $10,000 or more in physical cash, not a check, not a wire transfer, not an electronic payment, specifically cash. And here is the part that really matters and that almost nobody understands until it is far too late. That $10,000 threshold does not only apply to a single deposit made at one time. Under the law, financial institutions are required to add up all cash transactions you make within a single 24-hour period. So if you deposit $6,000 in the morning and then $5,000 in the afternoon on the same day into the same account as the same person, the bank is legally required to file a report, even though neither individual deposit crossed the $10,000 line on its own. And here is something that almost nobody in Canada realizes. You are never told when a report is filed about you. There is no notification sent to your home, no letter in the mail, no phone call from your branch manager, no email, nothing. The bank files the report quietly, FINTRAC receives it and processes it on their end, and you walk home with your deposit receipt in your pocket, having absolutely no idea that any of this just happened behind the scenes. In recent years, FINTRAC has received and processed over 30 million reports, which tells you just how routine and systematic this process is for financial institutions across the country. Filing these reports is not a rare or unusual event. It is standard operating procedure that happens thousands of times every single day. Now, here is the critical question that most people ask at this point. Does being reported automatically mean you are in trouble? The answer is no. Not by itself, and not automatically. Most large cash transaction reports go nowhere because there are legitimate explanations and legitimate sources for the funds involved. FINTRAC processes them, finds nothing concerning, and that is the end of it. But here is exactly where things can get extremely serious, extremely fast, And I want you to pay very close attention to what I am about to explain, because this is the part of the law that catches ordinary retired Canadians completely off guard every single day. I am talking about something called structuring, and it is a concept that most Canadians have never heard of, but that carries devastating legal consequences. Structuring is the act of deliberately breaking up financial transactions, including deposits, withdrawals, and transfers specifically to avoid crossing the $10,000 reporting threshold. Under the Proceeds of Crime Act, structuring is itself a standalone criminal offense. Not a fine, not a civil penalty, not a warning. A criminal charge that can result in prosecution. And here is the part that most people do not understand until they are already sitting in front of an investigator. You do not have to be involved in money laundering to be charged with structuring. You do not have to be hiding illegal money or proceeds of crime. The criminal offense lies in the intent itself. The deliberate act of staying under the reporting limit to avoid triggering a report is enough on its own to constitute a criminal offense under Canadian law, regardless of whether the money itself is perfectly clean and legitimate. Let me give you some real-world examples of how ordinary retired Canadians can get caught in this trap without ever intending any wrongdoing whatsoever. In the first scenario, imagine you sell your family home after decades of ownership and receive a portion of the sale proceeds in cash. You feel uncomfortable and perhaps even unsafe depositing such a large sum all at once, so you break it into smaller amounts and deposit them over several weeks because that feels more cautious and responsible. Your intent was simply to be careful with a large amount of money. But if there is any indication that you were aware of the reporting threshold, and investigators will absolutely look for evidence of that awareness, then that deposit pattern becomes direct evidence of structuring in the eyes of the law. In the second scenario, imagine you receive cash gifts from your adult children or grandchildren over the holiday season, and those gifts total more than $10,000 combined. You deposit smaller amounts periodically over the following weeks and months, simply because that feels more manageable and natural to you. But that pattern, the regularity of the deposits, the amounts consistently staying below the threshold, is exactly what financial institutions are specifically trained to identify and report as suspicious activity. And unlike large cash transaction reports, there is no minimum dollar amount for a suspicious transaction report. A suspicious transaction report can be filed on a transaction as small as $50 if the circumstances suggest any attempt to evade reporting requirements. Now let me be very clear about something critically important. The law does not require you to have specific knowledge of the $10,000 threshold for a structuring charge to be pursued against you. You do not need to know the exact rule or the exact number. The offense is structuring if you deliberately break up transactions to avoid scrutiny or detection, even if you had no idea exactly where the specific reporting line was drawn. Investigators do not need to prove you knew the $10,000 number existed. They need to prove you were deliberately trying to avoid detection or scrutiny of your financial activity. And here is the practical reality that should concern every retired Canadian who handles cash. If you consistently deposit amounts just below $10,000 when you regularly handle larger sums of money, that pattern combined with other circumstances is more than enough to trigger a formal investigation. You will not be warned first, you will not receive a courtesy call, and the investigation can be well underway and actively building a case before you have any idea whatsoever that it even exists. FINTRAC itself does not make arrests and does not directly enforce the law. What it does is analyze patterns across millions of transactions and share intelligence with law enforcement and regulatory agencies. When FINTRAC identifies a concern, it can pass that information directly to the RCMP, the CRA, CSIS, CBSA, and other federal agencies without requiring a court order, without your knowledge, and without any legal obligation to notify you that your information has been shared. At that point, the receiving agency decides independently what to do with that intelligence. The RCMP may open a full criminal investigation. The CRA may open a comprehensive tax audit. Because if significant amounts of cash are moving through your accounts, the immediate questions become, where did this money come from, and was it properly reported as income? This is precisely how a simple flag deposit can simultaneously become a FINTRAC matter, a full income tax audit going back multiple years, and a potential criminal investigation all running in parallel without you having any idea until the letters start arriving or the phone starts ringing. Now I want to tell you about something happening right now in 2026 that most retired Canadians have not heard a single word about. In June 2025, the federal government introduced Bill C-2, formerly known as the Strong Borders Act. The bill covers a wide range of border security and financial enforcement measures, but buried inside it is a provision that would represent the most significant change to Canada's cash transaction rules in decades. If Bill C-2 passes as currently written, cash transactions exceeding $10,000 would be completely prohibited across the board. Not just reportable, not just subject to extra scrutiny or documentation requirements, banned outright and made illegal. This prohibition would apply to virtually every individual, business, and charitable organization operating in Canada. Paying a contractor more than $10,000 in cash for home renovations would become illegal. Purchasing a vehicle in a private sale with cash above the threshold would become illegal. Making a cash donation to a registered charity above $10,000 would become illegal. And here is where the implications become even more serious. Under current law, businesses that fail to comply with FINTRAC reporting requirements can already face fines of up to $2 million and up to 5 years imprisonment. Bill C-2, as currently written, proposes increasing that penalty framework by a factor of 40, which represents a 40 times increase in the potential penalties. Whether those maximum enhanced penalties would ultimately be applied to ordinary individuals making honest mistakes or reserved exclusively for deliberate repeat offenders depends entirely on how the law is interpreted and enforced once it passes. But the legal authority and power to impose those penalties would exist. As of the time of this recording, Bill C-2 has not yet passed into law and remains under active parliamentary debate, but the direction of travel is unmistakably clear. The government is moving decisively toward a Canada where large cash transactions do not simply get reported and monitored, but get banned entirely. And even before Bill C-2 passes, the existing rules are already in full effect today. The $10,000 reporting threshold is active right now. The structuring criminal offense is active right now. The FINTRAC surveillance and reporting network is active and processing millions of reports right now. Bill C-2 would simply be the next step in a progression of tightening cash controls that has been building steadily for 25 years. Let me give you the full picture of just how wide this surveillance network actually reaches, because this is not only about your bank and your bank account. Every major financial intermediary operating in Canada is a FINTRAC reporting entity, including your bank, your credit union, your mortgage broker, your insurance company, real estate agents, casinos, money services businesses, and certain accountants and lawyers. When you interact with any of these entities in a way that triggers a reporting obligation under the law, a report is filed with FINTRAC. The agency's core function is pattern analysis across the entire financial system. It is not investigating a single transaction in isolation. It is assembling a comprehensive picture across thousands of transactions, spanning multiple institutions over extended periods of time. Automated systems run sophisticated pattern matching algorithms across millions of data points simultaneously, and small inconsistencies such as a deposit pattern that does not align with your declared retirement income or a series of transactions following a predictable rhythm consistently below the threshold can trigger automated flags without any human being making a conscious decision to investigate you. And critically, this intelligence sharing does not require a warrant, does not require a judge's approval, and does not require any judicial oversight whatsoever. FINTRAC operates under its own independent legislative authority to share intelligence directly with law enforcement and regulatory bodies. In most other areas of Canadian law, government agencies need a court order to access your private financial records, but FINTRAC is fundamentally different in this regard. It sits as an intermediary between financial institutions and law enforcement, and by the time law enforcement receives the intelligence, the legal threshold for sharing has already been met under FINTRAC's own statutory framework. The real-world consequence for most ordinary retired Canadians who get caught up in the system is typically not a dramatic criminal charge or arrest. It is a CRA audit that can be financially devastating in its own right. If FINTRAC intelligence reaches the CRA and the CRA determines that cash moving through your accounts does not align with your declared retirement income from CPP, OAS, workplace pensions, and RRSP withdrawals, they can reassess your taxes going back multiple years, add substantial interest charges and penalties on top of the taxes they determine you owe, and do all of this through administrative processes without ever using the word criminal. You can be completely financially devastated by this process without a single criminal charge ever being formally laid against you. Now, let me give you something concrete and practical that you can act on immediately. Here are 5 specific things every retired Canadian should know and do to protect themselves. First, if you ever need to deposit a large amount of cash, deposit it all at once in a single transaction and bring clear documentation showing exactly where the money came from, whether that is a bill of sale, a legal inheritance document, a written and signed gift letter from a family member, or any other proof of the legitimate source. Do not break it into multiple smaller deposits spread over days or weeks, because that pattern, regardless of your innocent intentions, can look exactly like deliberate structuring to both automated surveillance systems and human investigators. Second, make it a habit to document every significant cash transaction in your life without exception. If you receive cash from selling a vehicle, from a family gift, from downsizing and selling possessions, or from any other source, keep a clear written record including a dated receipt, a signed note, or a bank statement showing the origin of the funds. If your account is ever flagged and an investigator asks where the money came from, saying you do not remember is not a defense and will only increase suspicion. Third, understand clearly how your various retirement income sources interact with cash deposits in the eyes of the CRA. If you receive CPP, OAS, a workplace pension, or RRSP withdrawals, and you are also depositing significant amounts of cash into your accounts, the CRA will compare those numbers looking for discrepancies. Any gap between your declared income and the cash activity flowing through your accounts can prompt further scrutiny and investigation. An accountant who is familiar with retirement income planning can help you understand whether your current financial habits create any unintended exposure. Fourth, be aware of how Bill C-2 could affect your everyday financial life before it becomes law. If you currently use cash for significant purchases or transactions above $10,000, now is the time to seriously consider shifting toward traceable electronic payments for those larger transactions. Doing so is not only a potential compliance requirement under the proposed legislation, but it also creates a clear and verifiable paper trail that protects you completely if questions ever arise about where your money came from or where it went. Fifth, and this is extremely important, if you believe you may have unknowingly structured transactions at any point in the past, speak to a qualified lawyer before doing anything else at all. If you have been making regular deposits just below $10,000, and now realize after watching this that the pattern could be interpreted as deliberate structuring, do not contact the CRA directly. Do not call FINTRAC. Do not try to explain yourself to your bank. Speak to a criminal defense or tax lawyer first, because that conversation is fully protected by solicitor-client privilege. A lawyer can properly assess your specific situation and advise whether voluntary disclosure or another legal avenue is appropriate for your particular circumstances. Approaching the CRA without proper legal guidance in any situation involving potential criminal exposure is simply not in your best interest. Here is the bottom line that every retired Canadian needs to understand clearly. The FINTRAC reporting system has been in place and actively operating for over 20 years. Most retired Canadians have absolutely no idea how it operates or that it even exists. The structuring offense has pulled ordinary law-abiding people, including seniors who genuinely believe they were simply managing their own money responsibly, into serious federal investigations. And Bill C-2, if it passes in its current form, will tighten those rules even further still. None of this means that cash is illegal to use. None of this means you are automatically under suspicion simply for having cash. What it means is that the rules governing cash transactions in Canada are highly specific. The consequences of violating them, even unknowingly, are extremely serious, and the distance between not knowing the rules and that ignorance not being a legal defense is far smaller than most people realize. Know the rules, Keep thorough records of every dollar that passes through your hands. Never structure your deposits into patterns that could be misinterpreted. And if anything in this video made you think that you may have done that at some point without realizing it, please speak to a qualified lawyer today before taking any other action. If this information was useful to you, please share it with someone you care about, whether that is a friend, a neighbor, a spouse, or a family member, because this knowledge could genuinely protect them from a devastating financial and legal situation that they never saw coming. Thank you for watching and take care of yourself. This is Canada Pension Vault.